Hi, everybody, and welcome back to video number 2 in Chapter 3. Uh, Rutger Corporation incurred $30,000 in selling and administrative salary costs during April. These are our non-manufacturing costs. So this is how we would do those journal entries. Pretty straightforward. We debit salaries expense, credit salaries and wages payable. These are actuals. Same thing with depreciation expense of $7,000. We'll debit depreciation expense, credit accumulated depreciation. And then advertising is going to be $42,000, and other selling and administrative expenses totaled $8,000. So we'll debit advertising expenses, debit other selling and administrative expense, and credit accounts payable to pay for those. Pretty straightforward on those. You've had that before. So now, after we have completed those jobs, this has always been a little bit confusing to me because there's other costs in work in process other than the ones that are necessary that result in completed costs. So the cost of goods manufactured reflects the completed jobs in work in process. There's also costs still remaining in work in process for jobs that have not been completed. Okay, so that's what we're going to transfer in to finished goods inventory. So how we do that, I think, is pretty straightforward. Job Alpha was completed during April, but Job Bravo was not. So the following entry transfers the cost of Job Alpha from work in process to finished goods. And we will increase finished goods inventory and decrease work in process inventory. And because Job Bravo was not completed by the end of the month, its assigned costs will remain in work in process inventory and carry over to the next month. If the balance sheet was prepared at the end of April, the cost accumulated thus far in Job Bravo would appear in the asset account work in process for $72,000. Okay. All right. So then once we get it into finished goods, one of two things happen. Here's our cost of goods manufactured that comes in as a debit to finished goods. And what gets transferred out is going to be the cost of goods sold when we actually sell that product. What remains in finished goods, if there are any, is going to be in finished goods inventory. In this case, we only had one product in it and it got sold. So we didn't have any ending finished goods inventory. Okay, so for Ruger Corporation, we assume that 750 of the 1,000 gold medallions in Job Alpha were shipped to customers by the end of the month for a total revenue of $225,000. Because 1,000 units were produced and the total cost of the job on the cost sheet was $158,000, the unit product cost was $158 per. Okay, so the following journal entry is going to record the sale, all of which were done on account. So we're going to expect to get that from customers for $225,000. Here it is. We debit accounts receivable, credit sales, and we're going to debit cost of goods sold for $118,500 and credit finished goods or reduce it by $118,500 because it's going out to our customers. And as you would know, hopefully, we could take the 158,000 here and multiply it by 750 divided by 1,000 to get this $118,500. Okay. Now we're going to take a look at preparing schedules of cost of goods manufactured and cost of goods sold and an income statement. So both the schedules are going to contain three elements of product costs: direct materials, direct labor, and manufacturing overhead. The schedule of cost of goods manufactured summarizes the portions of those costs remaining in ending work in process inventory and transferred out to finished goods. Okay, then bullet point number 2, the schedule of cost of goods sold summarizes the portions of those costs remaining in ending finished goods inventory and transferred out to cost of goods sold. So let's look at that. Here is our raw materials inventory. So we start with beginning inventory, we add our purchases, that gives us raw materials available for use in production. We back out ending inventory, and that tells us how much actually moved into manufacturing work in process inventory. Okay, now we also have manufacturing costs here. So direct labor used in production and manufacturing overhead applied to production are added to direct materials to arrive at total manufacturing costs. Okay, then next, we're going to move the total manufacturing costs for the items that we complete in work in process inventory into work in process here. And the beginning work in process inventory is added to that total manufacturing costs, and that gives us the total manufacturing costs to account for. Okay, be very careful on your terminology here, because that's going to look very similar to terminology you're going to see in a few minutes. Total manufacturing costs to account for. Now, what we're going to do, we started with beginning work in process inventory, we added the total manufacturing costs, and that gives us the total manufacturing costs to account for. Now we back out what we did not complete, which is the ending work in process inventory, and that gives us the cost of goods manufactured, the cost of the finished goods made that month in work in process. Okay, now the cost of goods manufactured is then added to the beginning finished goods inventory to arrive at cost of goods available for sale. So we start here with beginning finished goods inventory. We add the cost of goods manufactured that we just did in the previous slide, and then that gives us the cost of goods available for sale. That's the cost of finished goods available for sale. We back out the ending finished goods inventory, and that tells us the cost of goods sold. So you'll remember the work in process we did similarly. We started with beginning work in process inventory. We added the manufacturing costs for the period. That gave us our total manufacturing costs to account for, and then we backed out our ending work in process inventory, and that gave us our cost of goods manufactured, which we moved into finished goods. Okay, so the ending finished goods inventory is deducted from this figure, the cost of goods manufactured, to get to a cost of goods sold. All right, let's see. We'll do a quick check here. So if beginning raw materials inventory was $32,000, and during the month, $276,000 of raw materials was purchased, a count at the end of the month revealed that there were $28,000 of raw materials still present. What is the cost of the direct materials that we used? Let you look at that for a second. And what we do here is we're going to take that $32,000 beginning inventory, we'll add what we purchased, back out our ending inventory, and that is shown here. Here's beginning raw materials. Here's what we purchased. Raw materials available for sale, for production, I should say. We back out our ending raw materials inventory, and that gives us the raw materials used in production of $280,000. Okay. This formula and this approach is going to be used very much in the next 2 or 3 chapters. So please be sure you understand that. Okay, so here some direct materials are used in production, totaling $280,000. Direct labor was $375,000, and $180,000 of manufacturing overhead was added or applied to production for the month. What were the total manufacturing costs incurred for the month? Well, that one's going to be pretty easy. We're going to take the $280,000, add the direct labor, add the applied manufacturing overhead, and that will give you the manufacturing costs incurred for the month. Incurred is a little misleading because this is applied overhead, which can be different than actual because the applied predetermined overhead rate is an estimate. Okay, and then a quick check 3 here. We're going to begin work in process inventory with $125,000. Manufacturing costs were added to production for the month for $835,000, and there were $200,000 of partially finished goods remaining in work in process inventory at the end of the month. What was the cost of goods manufactured during the month? And just like we just did with raw materials inventory, we're going to start with beginning work in process inventory. We're going to add the $835,000 that were added during the month. That'll give us the total manufacturing costs to account for. And then we're going to back out ending work in process inventory to get us to the cost of goods manufactured. That's the cost of the finished goods manufactured. Okay, and we're going to move that into finished goods inventory. And that looks like this slide does just that. We begin finished goods inventory was $130,000. The cost of goods manufactured, you'll remember here, was $760,000. We add that, well, I should say, the cost of that was $760,000, and ending finished goods inventory was $150,000. So we do the same approach. We start with $130,000. We add the $760,000. That gives us our total finished goods available for sale. But we only have $150,000 left, so that means we must have sold $740,000. Okay. So now we're going to look at computing under and over applied overhead and prepare the journal entry to close the balance in manufacturing overhead to the appropriate accounts. Now, what we're going to do here is give a definition of under applied overhead, and that exists when the amount of overhead applied to the jobs during the period using the predetermined estimated overhead rate is less than the total amount of the overhead actually incurred during the period. And if the predetermined overhead rate gives you an amount that's greater than the total amount actually incurred, then you would have over applied overhead. Pretty easy to understand there. So what we do here is they had actual overhead of $650,000, total of $170,000 direct labor hours worked at $4. So if I multiply $4 times 170,000 direct labor hours, I get 680,000. So we've applied more than 650. So we have over applied overhead of $30,000. What are they going to do? We'll have to wait till the next video to find out.